Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host, Smart Property Investment Show. Hope you're well. Don't know where you're listening into this. A lot of you are probably driving in your cars. Seems to be a pretty popular place to listen to podcasts, walking your dogs. At the gymnasium, for those people who are looking after themselves, highly encourage 1 hour of power at the gym with 40 minutes of the Smart Property Investment Show to keep you engaged and connected. Now, I reckon people who look after themselves physically typically also look after themselves financially. Well, I like to think that's the case, so you're on the right track. But thanks for joining us wherever you are, whoever you're tuning in. I don't think many people listen to this on the train anymore because I think most people don't get to train anymore as a result of this COVID-19, particularly those knowledge workers who are working from home. And it's interesting, I was looking at the papers. I sort of habitually read. I get all the papers on Saturday morning. I spend a weekend sort of picking through them at different times and just watching all the narrative and the discussions around how property in Australia is changing and evolving. And we're all familiar with the big headlines at the moment around inflation and there's a new government. Interest rates are hiking. Unemployment is the lowest it's ever been. Vacancy rates are the lowest they've ever been in most places. And it's a nice spot to look at as an observer, but also a participant inside of property and give my view, my lens on it and how I see it playing out. And my job here, I'm just a journalist. I'm here to narrate and also navigate conversations with people who know what they're talking about. And it's a great privilege that I get to do that and get the inside read on what's happening and hopefully share it with all of you listeners. And that's my job. And from the feedback we keep getting, it sounds like I'm doing it pretty reasonably well, but please keep the feedback coming. The team get a real kick out of it. Anything else you'd like to see or hear from us, get in touch. Let us know, editor@smartpropertyinvestment.com.au. But please also, those reviews coming in across those podcast players and platforms where you listen to this, the team, the production guys and girls who do the heavy lifting, they get a real kick out of it. But let us know what you wanted us to do. As we enter this new market, who knows where it's going to go? I'll tell you one thing, guaranteed, interest rates are probably going to still going up. So take that as a given. But I've been talking about that for about 5 or 6 years now. Interest rates do go down and interest rates do go up. And that's the natural market cycles. We're in an upwards rate trajectory now. A lot of it driven by a lot of the things we've been chatting about on this show over the last period of time and we'll continue to chat about. So hopefully we can arm you with the interpretation of this information so you can make more informed investment decisions. So you too, like Smart Property Investment, if you've been tuning into our portfolio since we've grown it, continue to grow and evolve. The smart investors are capitalising on this market. They're not scared of it. They're alert. They're getting armed and they're ready to go. And we'll have more conversations with people as we navigate this moving forward. But I want to get a bit of a sense for what's going on right now. There's this big word about inflation. Now, for a lot of people, if they're new to property, they probably haven't been in a upwards inflationary cycle. If you look at most mortgage brokers these days, a lot of them haven't even been in the market, which has seen upwards rates. And also for a lot of property investors, if you only got into the market sort of 6, 7, 8 years ago, you probably haven't seen an upwards rate cycle either. So new ground for a lot of people. So I want to get some sense of it all and what it all means. And you can be scared of the big inflation boogeyman. You can be scared of the big interest rate hike boogeyman. But let me tell you, that's natural market cycles. So strap in, get used to it and work out how you're going to position yourself around it. Now, I read a book once upon a time, and I've read a lot of property books, and there's a lot out there, and I'd say I'd score this one mediocre to average, A Surfer's Guide to Property Investment. Paul Glossop's the guy that penned that, but I was picking through it the other day. I found it on the bookshelf, and I went, let's see how close this guy was to understanding where this market was going to head. And he had some good data in there. And I sort of, I can't remember what page it was, but I put a dog ear on it to go back to it. It was talking about how inflation has affected other markets in history. And I've spoken to Paul before and on this podcast around lessons from history and how you can interpret that to use it to make your plans for the future. So I thought I'd bring him back in the studio and see what's going on, see how close he was to his understandings of those inflationary markets and what it means and what it does to property and what we can learn from that. And I think if we start from there, Paul Glossop, founder, Pure Property Investor, director there, how close were you when you penned that book? How many years ago?
Well, mate, I think the one thing that I'll take some good confidence in is you and I, if I talk about what we've learned from history and what we expect will happen in the future, we did a video feed essentially, or a vlog or a webcast, whatever you want to call it these days, back in April 2020. And at that time, the discussion wasn't inflation. The discussion was a pandemic. The discussion was a recession.
That's right.
And we had this same position, basically exactly the same position in the property market to say, wow, for a lot of people, uncharted territory, what do we think is going to happen? So instead of us saying, well, here's where I lick my finger and put it in the air and expect, well, it's a nor'east wind, so this is going to happen. The reality is we said, well, what happened over the last 3 major corrections to the economy? And we went from the 70s, the 80s and the 90s, and essentially the 3 recessions that happened there, and a little bit around what happened during the dot-com and GFC crashes as well. The reality of what we talked about back then, and anyone can actually, I think they can jump on the SPI website because I think the recordings.
I remember recording it. It was over. It was just as COVID was taken. And
Zoom was fresh for these types of things.
And you thought you had the COVID, so you didn't come into the studio.
Yeah. And I think we're all sort of figuring out what to do and how to do it. And it's still up on my website. So Pure Property Investment, if people want to go and look at that recording, they can have a look at it because this was literally more than 2 years ago now. And the outcome of that, we said that, hey, the last 3 recessions that we had in Australia, the following 5 years is the outcome was that there was a touch over 33% average total growth across Australia in the following 5 years from that impact to the economy. Lo and behold, here we sit 2 years after that was recorded. The property market in Australia has seen a bit more than 30% growth across the board in that entire time. And that was an average. So the reality is here we are. We're sitting 2 years past looking at that, looking at the data of why, how, and we went through all the machinations. I won't jump into that again. But again, data and the previous history of what happened in that data and the reasons why things were stimulated and the reason why the property market played out the way it did was all pretty obvious at the time. And to be honest with you, we're looking at the same information now to say, well, what happens when you get high inflation rate environments, high or increasing interest rate environments? There's some key telling aspects. We haven't seen it granted for a good 25, 30 years, but the same data is still available to anyone who's prepared to look at it. It's all available in Surfer's Guide to Property Investment. We made sure we looked at that information to say, well, this should tell us and it should predict. And we've got a bunch of information we're going to share today on what we expect and what we think might play out over the next 2, 3, 4, 5 years.
So when we recorded that, Paul, 2 and a bit years ago, I probably need to go and listen to it again. I'll watch it myself. I can't remember exactly what we spoke about. So the question I've got for you, did we get it right?
Yeah. Well, mate, we got it right and it probably happened a bit quicker than what we did expect it was going to happen. And we were saying, look, hey, not every...
So we weren't scaremongering.
There was definitely not scaremongering because at the time it was just after CBA came out with potentially up to 33% reduction in values. Everyone was averaging, the big four were averaging between 10 and 20% drops in the next 12 months in property values. And we said, hey, let's just tap the brakes again. And guys, let's not just make these assumptions based on random aspects and expectations. Let's base it on facts of what's happened previously. And the facts were that the following 5 years saw some uncertainty initially, followed by growth based on the fact that unemployment trended downwards, stimulation from the government increased, supply dropped, circulation of people going overseas, all these types of things played into the whole narrative of what played out, and it played out pretty accurately.
Yeah, and we don't know what yet is going to happen in terms of the tempo of increases to the official cash rate and whether or how or whether every single bank or lender will pass on all of those increases coming through. Don't know, but it's going to happen. And this podcast today is probably as relevant as what it's going to be in sort of 3 months' time and 6 months' time in terms of this inflationary pressure. But let's just chat about inflation for a second before we go about, okay, what does it all mean and what's it going to mean for property and stuff? Well, how do you view inflation in this market? Like, give a sense for property investors because you can read about it and you get economic boffins sort of telling you all about it and you go, I don't really understand that. Well, what are you really talking about? People go, well, why are they making things more expensive like my mortgage when things are already more expensive? isn't that like
yeah,
the
bit
opposite
counterintuitive.
of
yeah. And I think we spoke about this a couple of months ago, mate, when we sort of saw that this was all about to kick off, and we said, the question was, what is ultimately the reason behind inflation, and why do we increase interest rates? And the reality is that, and we spoke about this off air just recently now as well, is that it's a bit of a weird one this time round, because I think technically when things get more expensive, i.e. when things inflate in value, goods, services and the like, it usually then means that we've got wage growth, and then ultimately the overall opportunity for things to get more expensive has to be tempered with the ability for the RBA or the central banks of the world to say, well, let's make money more expensive to a degree to curtail the spend and the demand on those goods and services, and ideally drop the demand. And the demand should then bring down inflation, and that should then change interest rates. The reality, though, this time around is that we've got a supply chain issue, which is still, I think, for the central banks across the world is the unknown at the moment, because wage growth isn't necessarily something that is obviously playing out. And we're definitely not seeing wage growth anywhere near inflation. Wage growth is nowhere near the 5, 6, 7%, nor is it at the 8, 10% in the US or any other parts across the world where inflation's out of hand. Supply chain issues are certainly there, and they'll probably remain there for another 6, 12 months. But that may, to a degree, play out to show that this inflation position may be a bit more transitory than this embedded inflation position, which sometimes I think at the moment is a little bit more uncertain. So as far as where and how and why, and the reason why interest rates are increasing, and they will continue to increase until we see that headline inflation drop between that band that they want to see of that 2 to 3%, is that until we really see this brought down and we start to see demand on goods and services start to decrease, we're not going to see the banks be comfortable with seeing headline inflation 5%, 6%, 7%, 8%. And we will see some of these bigger 50 basis points rather increases that we may see shortly in 0.25% and getting us all the way up to somewhere in that 2.5% range in Australia sometime very soon, I think, because ideally it gives them a bit more ammo to cut rates as and when they need to stimulate again.
Yeah, you're absolutely right. And this is how the Reserve Bank of Australia uses interest rates as a way to sort of trigger the economy in different directions. So there's lots of reading out there. You can go and check it out. But to your point, Paul, around getting the official cash rate to 2.5%, and now let's remember the official cash rate doesn't necessarily represent the mortgage that you're paying. There's a gap between the official cash rate and what your mortgage is. And a lot of lenders will say, well, it's irrelevant to us because we get our money from other places. So, they don't link up really that much. And lenders can actually increase rates, even though the Reserve Bank doesn't do anything with the official cash rate. So you need to be dialed into this sort of stuff. But 2.5% official cash rate, like a lot of people think, oh, that's just absolute madness. Like, how can rates be so high? That's a pretty normal, so it depends what your definition of normal is. But 2.5% is probably what it was about, I can't remember exactly, 4 years ago? Yeah,
basically. Yeah. It was more or less where it was for that entire decade between 2010 and 2020. You're probably talking the average consumer rate was hovering between 4 and 5% in that time. Towards 2010, 2012, it was probably more like 6 to 7% the average punter was paying for a residential investment loan or a home loan. So that's actually a fair bit lower. I guess the biggest difference, and I think what a lot of people are a little bit uncertain on now is, okay, well, you can talk about interest rates and what it costs to borrow your money. That's all good and well. The biggest difference and the biggest factor we've found over time is that what is going to influence property prices is, A, what is the average annual or even weekly take-home pay coming into every household, and what's the average percentage of that pay that goes to a mortgage? When that goes up or goes down, that's basically where it puts strain or gives ability for people to pay more or pay less for property. So if as a mechanism, if you've got $100,000 that hits the bank account every year and your mortgage rates or your mortgage commitment's $40,000, that's 40% of your average annual take-home salary is committed to your mortgage. Now, if that interest rate goes up and all of a sudden becomes a $50,000 contribution, then that's $10,000 less than that person has, unless their wages going up that another $10,000. And this is that sort of that yin and yang. And then when you see that interest rates go up, if people's incomes don't increase, then that's when they'll say, well, hang on, we have to pay $10,000 more for our mortgage this year.
I better stop
buying that coffee once a day. And this is like, if I was putting it really, really simply, like saying, oh, instead of getting that $12 iceberg lettuce that we're hearing about at the moment, this is where I'm like, well, let's just get the pre-packaged stuff. Or instead of going out that once a week to that restaurant, we're going to eat in.
Well, hence the reason why at Smart Property Investment, I'm drinking austerity coffee at the moment, the old international roast.
It's not very nice, by the way. Thanks for offering me one too. It's definitely austerity for the guests as well.
Got to look after the bottom line. Have you noticed yet, Paul, and I want to get into some of these things around inflation, but have you noticed that your clients changing their discussion with you? Like whether current clients with properties going, oh, I wanted to buy again, Paul, but now I can't, or wow, I really need to do something about it because I'm starting to worry about whether or not I can hold this investment property?
Definitely the former, definitely not the latter. I think holding the investments that they've got, I think if you set yourself up correctly, you should be buffered for anything that's going to happen, and you also should be thriving for things that probably will happen over the next 2 or 3 years. But we're certainly getting that conversation from new clients and existing clients who are searching for assets for right across the country, saying, well, I'm kind of unsure as to what to do. I might just wait to see what plays out. And our rhetoric is the same as it's always been, is saying, well, are you buying this property for a 12-month or a 24-month or a 36-month outcome? And if they're a client of ours at Pure Property, I can unequivocally say our advice would never be buy a property to get an outcome in 3 years. If you get an outcome that you got in the previous 2 years, fantastic, 40, 50, 60, 70% growth. However, you're not buying for an outcome. You're buying for an outcome in 10, 15, 20 years. And so for us, the discussion is more on, well, what is the risks of buying now versus buying in 3 years, and what are the rewards of that? And ultimately, it comes down to the risks typically are you can't afford to hold based on the cash flow. And if we're holding it and buying it now and the rates go up another 1.5%, are you in jeopardy of being able to hold that asset long term, or are we in a position where you're okay based on the fact that we're buying in this market for these reasons, or these vacancy rates and this cash flow position and this growth in rental and this overall 10-year outlook? So it's probably more of a re-education opportunity, because a lot of people, if they're Sydney or Melbourne based in particular, they're looking at potentially $1 million property that's got a $600 a week rent, and you're talking a 2 or 3% rental return when you're essentially looking at a position where you're like, well, hang on a second, that's negative 10 grand a year and potentially become 15, 20 grand a year negative. So there's opportunities there where people have to get a lot more informed.
And have you seen yet, and I was reading in the papers on the weekend, already people are talking about how, I think for the first time in a long time, super funds are going to go backwards this year, right? Like akin to how it was during the GFC, and how some Aussies now are going to have to work for all these extra years because their super funds are being hammered as a result of equities markets getting slaughtered. Have you seen any sort of increase in calls going, oh, it's shares, equities aren't working for me. Why didn't I invest in property earlier?
Yeah.
Are you getting that yet?
100%. Yeah. And I think that's going to happen more and more because, I mean, as of literally only this week, if you look at some of the headline data, the ASX is currently down more than 10% of where it was last year. S&P over in the US, that's down more than 10% of where it was this time last year. Bitcoin down over 40% versus where it was last year. Gold down more than 5% of where it was this time last year. Bonds, US bonds, more than 14% below where they were this time last year. So you kind of look at it and you're like, well, where can I actually put money if all of these, you're talking gold, you're talking Bitcoin was supposed to be the gold of the crypto space, you're talking bonds, all these things which are typically cash rubbish in the bank, because if you've got inflation at 8%, if your cash is sitting in the bank at 1 or 2% returns, and you're losing 5% a year on that alone as well. So you kind of think, well, hang on, in the same token, Australia property has increased by 20%, residential property, 20% in the last 12 months. US, again, 20% in the last 12 months. Commercial property increased to 10% in the last 12 months. It goes on and on and on. And I look at this is that property is highly inaccessible for a lot of people. Granted, it's expensive. Absolutely. It will remain that way.
Yeah.
Unfortunately, for a lot of people who want to wait for it to fall,
it makes me think about a common friend that we have who lives internationally, who I've been chatting to him for years about property, 10, 15 years, and he's always chucking his money in other asset classes. But he got onto the property bandwagon recently.
He did indeed.
Did he have a good experience?
Well, he's been a client of ours 3 times over now, and I think if he was listening to this, I don't know if he does listen, tunes in from Singapore, but the reality is that it is also those tried and tested people who sit on the sidelines and look at other asset classes that, we talk about those scenarios there that they're genuinely, for me, again, going back to why property for us has always been very predictable and not necessarily going to be the best of that year or the worst of that year, but we know that consistency with property is absolutely, and right now, one of the biggest benefits of property is because it's highly illiquid. Yeah. We talk about this in the equities traders, et cetera, talk about property being a problem because it's highly illiquid. Well, show me the last time that there was a sell-off, ubiquitous sell-off that all of a sudden shed 20% in a 2-week period.
It's a really good point. I was having a chat. Sometimes we run it on the Property Investment Podcast Network discussion I have every week with Tom Panos, who is one of the big sort of players inside of business real estate, big auctioneer, writes a lot for the News Corp papers. Most people would know him, and we're having a chat around, I think, if he was listening to this, he'd, I don't know if he does listen, tunes in from Singapore, but the reality is that it is also those tried and tested people who sit on the sidelines and look at other asset classes that, most people would know him, and we're having a chat around how property markets are going to come back. And our point was it's probably already come back 10%, right?
Yep.
You just don't yet know because the data hasn't flowed through. And also, you don't see that. Like I look at my share portfolio and it's down 30%, right?
Yep.
I look at it and I just go, what a waste of time, energy and effort. But I look at my property portfolio and because I'm not pricing it every day, I just go, no worries. It's okay. Everything will be all right. And to that point, speaking about Tom, and I'll get your views on this before we go to a break, Paul. He scored, and he was me and him had a bit of a debate about it. He scored the Reserve Bank of Australia 1 out of 10.
Yep.
He said the Reserve Bank of Australia has let Australians down because a lot of investors, owner occupiers, and also property investors. We're all property investors. You buy property, you're a property investor. It doesn't matter whether you live in it or rent it out. We're banking on the fact there wouldn't be any interest rate rises to 2024, and now they're copping it at the start or the midpoint of 2022. Thoughts?
Yeah, mate, I think they'll learn a lot from that rhetoric and that standpoint that they took for the best part of 2 years when they were basically saying, hey, guys, don't stress. Prices of money aren't moving until 2023, 2024, which was that we heard that for a couple of years nonstop. And I think people if you're not going to trust the Reserve Bank, a lot of people think, well, who are you going to trust? And I think from that point, they probably will trust them a lot less when they hear the minutes come out and they hear the language come from, Dr. Lowe at the moment, who knows who the head of the central bank's going to be at some stage further down the track. But I think they'll learn a lesson by saying, don't forecast. Don't tell people what's happening in the next 3, 4, 5 years. Talk about what's happening right now because you've got data on what's going on right now.
It's hard. And to your mates over in Bitcoin land, that's their argument about sort of decentralising banks, right? Because they don't want them doing what they do. Yeah, look, I didn't get stuck in it. Tom tried to pull me into his discussion, and I was like, "No, yeah."
And I think this is
leave me alone, Tom. I'm not going to take a picture against the.
But I know from my client base at Pure Property that we've got a lot of clients who still have money in crypto, and over the last 3 or 4 years in particular. And you and I have talked off air multiple times about it. I still don't necessarily understand it. There's a lot of people who are highly educated in this space and read a lot and expect that there's a lot of predictability. But the reality is the last couple of weeks in particular have seen things which most of these experts probably thought would never be the case, where you've got these exchanges who essentially have stopped the opportunity for people to take out their money. All these things that people feared about third world country banks, where they're like, oh, okay, in times of crisis, the money is no good in the bank because they can basically turn off the opportunity for you to get the money out of the bank. Well, all these things are happening, unfortunately, right now. And I think this will leave a sour taste in a lot of people's mouths who probably invested heavily in that space and thought, well, even if it goes south like the equities market, I can just take it out. Well, even in that instance, even if people have lost 20, 30, 40% last year and they want to take out and essentially take the shelter, they can't.
People are telling me, oh, you can do this, but it's pretty hard to rock up at Woolworths and buy some lettuce with your Bitcoin money, right?
Still is.
If things go to the wall and you want to be liquid and you want your cash money, anyway, this is not a Bitcoin beat up, but I thought there's a drop below 20,000 here. I think
it dropped below a couple of days ago. I don't know where it's tracking right now, but I think it was tracking about 17,000 at its low point on the US when we were sort of looking at the data last.
There you go. Look, let's dig into some of these numbers in your book, Paul, and see their relevance today. When did you write that? 2 years ago?
About two and a half years ago, yeah.
Probably 3 years ago.
Yeah, 3 years ago, yeah.
Let's go to a quick break. Stay with us. Back in a moment.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop from Pure Property Investment. Now, the Service Guide to Property Investment.
Yep.
Not a bad book. Great forward. We've spoken about this before.
We have spoken about the forward.
When's the next instalment coming? It needs an update. 2022 inflation update.
It's looking at a COVID and inflation update, and I think the reality is it's got so much to write about now. So we're in talks with a couple of publishers about potentially.
Can you put my name on it and as a co-author, so I'll write you one chapter? Do
you want to be behind me there on the cover, or should I get maybe a decal to go on the surfboard?
You should just stick it in there, right? You put a photo of me there drowning in the
in the backhand up. up, lifesaver, chucking the flotation device.
The little Noah sort of drag. That looks like a stage photo, by the way. That surf looks pretty miserable.
Mate, it was actually a good day. I had actually a good surf session. He came out in the water with me. I got a whole bunch of images from that. It was actually a nice day down at my local, about 3 foot offshore. It was springtime, beautiful.
Can't complain.
No complaints at all.
But anyway, there's a whole bunch of numbers in there around inflation. Now, tell me what's happened in the past when inflation has kicked in, Paul. Last cycles.
And this goes back to, what are we looking at? And as opposed to you and I just predicting for the sake of predicting, we looked at what has happened in the last time where we've gone through a relatively similar scenario. So if we go back to between about 1988 and 1998, so call it that 10-year time frame, in that time we saw inflation average somewhere between around 4.5%. It was as high, sort of around that early 90s, as high as 8% in that time. So we're kind of seeing similar numbers, at least for the short term that we're seeing right now. I don't expect we're going to see this inflation drag out for that long, this stagflation number. However, that was there. So we're seeing the immediate numbers that we're seeing right now. At that time, and no doubt we've heard it so many times over and over and over, that back in the late 80s, early 90s, interest rates were as high as 17, 18%. And they legitimately were. They weren't there for a very long period of time, but they averaged, for that 10 years, averaged about 8%. So you saw about interest rates of about 8%. So double, in effect, at least double of what our average rate is we're paying right now. If you look at that compared to where unemployment was at that time, we went through a recession in the early stages of that, but we went through unemployment as high as 11% at a period of time. Then it averaged somewhere around about 7 or 8% during that entire decade. So you've got some pretty significant headline numbers to say. If you explain that to someone and said, if you had an economy with all these numbers, what would you expect to happen in the property market? Pop quiz, without knowing the numbers.
A tank.
Well, that's ultimately what you'd expect. Well, if you look at the averages for that decade, between 88 and 98, Australian property grew by about 71% in that entire decade. And that's from 88 to 98. And that's looking at all the different market segments. Now, that's still a very strong return. That's unequivocally a strong return, strong position, very predictable, and averaging around that 5-6% compounded annual return. The difference is, though, is that you can't all of a sudden think that Australian property is going to deliver us another 70% between 2022 and 2032. So between now and the Brisbane Olympics, do we expect we're going to see another 70% capital growth? Well, my answer to that personally is yes, depending on where you buy. Because going back to that data...
This when he goes, you should use a buyer's agent.
Well, not any buyer's agent. No, look,
as if you'd say that.
Mate, you can edit it out if you want to, but I'm just going to say this comfortably, that the reality is that if you bought in that same market that we just talked about, 88 to 98, if you bought in Adelaide in that time, and I'm not suggesting Adelaide's a good, bad, or a different market now, but at that time, if you bought in 1988 and you sold in 1998, you would have made 28% total. No, then you've got to minus all your expenses, holding costs, etc. If you bought in Brisbane in that same time, you would have made about 105%.
So Adelaide was 28%.
28%.
Over 10 years.
Over that 10 years.
So not a lot of growth.
Not a lot of growth. Once you factor in, that doesn't factor in your yield, return, etc. But if you factor in your selling costs, buying costs, holding costs,
neutral.
You might be making 10% on your money.
You pay the whole way through if you pay off the principal. Yeah.
But again, if you're buying in Brisbane in that same time, you're buying in 88, selling in 98, you made 105% gross on your money. Huge return, completely different to the Adelaide market. We're talking two major markets then. They weren't small boffin markets with no population and no major economic drivers. They're pretty regulated, normal markets, relatively mature. And again, for me, when you're looking at the average of 71%, and when everyone is listening to this podcast and they're looking at the 6 o'clock news, I guarantee at least once a week for the next 12 months, we're going to hear some sensationalist media saying the market's dropped, the market's taken a dive, the worst reductions in living history, highest inflation that we've ever seen. They'll say it all because I'll average everything.
And add to that, I'll tell you, it's going to be dodgy banks and mortgage brokers giving people loans that they shouldn't have got.
Yep. And there's going to be some interviews on A Current Affair with a couple of people saying, look, they just gave me the money. It's not my fault. I'm going to take them to court, etc. People will ultimately defer responsibility, and that always happens in these times. But the media are typically going to be the people who are going to give these stories the airtime that they don't deserve. But I guess my point with all this is going back to the money in the market, holding that money in the market and the average return during these times. And the last previous time we saw this, we saw those numbers. And I'm not going to go out there on a limb and say, hey, you expect 71% growth between now and 2032. But if we fast forward a decade and we have this podcast and you and me talking about, remember that time we recorded in 2022, I would not be surprised at all if we saw that somewhere there or thereabouts. Because one thing that I do expect personally is in 2 years' time, when we hit the top of this interest rate cycle and we probably see the economy really slow, if not reverse for a little bit, we're going to see interest rates cut again.
So the point I would take from that, and you speak to most people in property listeners, and if they know what they're on about, and there's really fortunate in Australia, we've got this sort of emerging group of buyers agents, property strategists. Most of them will probably have a similar narrative to Paul, but what I would say about what Paul said, and I agree with this, it's where you buy in this current market. So I'm going to give Paul the length of this break to actually work out where that is, and I'm going to get him to tell us when we come back from this break. Stay with us, back in a moment.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. Phil Tarrant, Smart Property Investment with Paul Glossop. Now, Paul, you've told us that as we navigate this upwards rate cycle, you sort of say in a couple of years probably, to cap it out at what, 2.5%?
I think somewhere there, thereabouts.
Thereabouts, which means that your interest rates are probably going to be twice as much as what they are right now. So if you're paying 4% now, expect to pay about 8%.
Oh, I wouldn't go. I think look,
that's a really good point, Paul. Before I know you're going to tell us where we should be buying because you said it matters where you buy. It's markets like this when banks get hyper competitive.
Yeah,
hyper competitive. Now, mortgage brokers, Paul, just cracked 70% of market share a couple of months ago. So 70% of whether it's got to say that, who knows? But 70% of all home loans written by mortgage brokers. Now, I tell you what, it's in this market when banks will and you can negotiate with it. Just because interest rates are going up doesn't mean that you can't speak to your bank and say, yeah, I'm not too happy about that. We should do something about it. You should go and speak to the team over it. I'm using them myself right now in the Smart Property Investment portfolio of Finny Mortgages, finny.com.au, or your mortgage broker, because this is when you got to start looking at your interest rates, Paul. But this is the market where it matters what your interest rate is.
Massively, like more than we've seen in a decade. And not just what your interest rate is, but having your mortgage broker essentially figure out how to make sure that not only are you getting the sharpest rate, but you're getting out the equity gains that you've got in your property portfolio that you would have received over the last 2 or 3 years. Because every time there is opportunities like this or times of crisis, there will be opportunities for buying.
Let's chat about that. So let's talk tactics for a moment, because then I want you to finish this podcast up with some areas where our listeners should be considering for growth in inflationary markets, growth in property. Tactical stuff in mortgages, or tactical stuff for property investors right now. Get your money liquid.
Get your money liquid, which means refinancing, extracting equity. And if your broker's not necessarily going to be doing it, like you said, you jump on Finny. Finny will be able to, I know, for instance, there's plenty of clients who I've spoken to recently who have spoken with their brokers to say, hey, I've seen 25% growth. Surely there's an opportunity to revalue, extract that equity, even if I'm not going to spend it, get that money released.
Yeah.
This is the time
chuck
to
it
do
an offset.
that.
Now, the question people are going, well, if property's coming back 20%, that means I'll be in negative equity. Potentially, if you spend the money, you deploy it elsewhere. But if it's sitting in an offset account, you can always put it back into your mortgage. If
It costs you nothing. Literally costs you nothing, other than the application. But again, you look at anyone who's made the most out of a cycle, then the next cycle, then the next cycle. You can't do it by being reactive. You must. This is the proactive part of being a great property investor. You get yourself prepared, get the money out, because unless that money's liquid, it's as good as a fugazi. It's rubbish. It's just you talking.
Fugazi.
Essentially, it's made up. So for me, it's you can say my property grew by 40%, but will show me the hard currency that shows me that, other than an app that says, hey, it's gone up. Oh, hang on a second. Next month they're going to say it's gone down. So that money's essentially irrelevant as far as how much it's gone up or down or sideways.
Yeah.
Get the money out.
Yeah. And if you don't know what an offset is, speak to your mortgage broker. Essentially, it's just pool of money set against your mortgage. Where that money comes from is irrelevant, really, whether you chuck it in there yourself or it's from the proceeds of a refinance. It just means that you're paying interest on less money. You still got to pay the principal repayments if you're on P&I, but you can read all about that on smartpropertyinvestment.com.au. Your point, Paul, was, and using the experience through 88 to 98, 88 bicentennial, great time for Australia. 200
Great time.
years. I remember looking at the tall ships as a school kid.
Absolutely. I've still got a $5 coin with the bicentennial. Ooh,
wow,
fancy.
Still worth $5.
about $5.80.
$5.80. Good investment.
Inflation.
Good investment. I see. They're looking to soften some of the rules, or accountants are sort of getting stuck into artwork and stuff. So which is a bit of a
That's
grey
good for
area.
you. Yeah.
Oh yeah. Just got a few Picassos hanging up in the shed. But your point being that Adelaide grew at 28% over 10 years and Brizzy doubled essentially over 10 years. And we all know there's this adage of property grows between 7 and 12 years, it doubles in value, right? And I think the average growth for Australia since the dawn of time of numbers getting kept is about 6.5% as the average price growth in Australia.
Annual return,
which ain't bad, to be honest.
Well, that excludes cash flow as well.
Yeah, absolutely. So the point being, be careful where you invest and what you invest in.
Correct, absolutely.
So you got where and what are probably the key things, and why.
Yeah.
Where, what, and why.
Yeah, so before I go into sort of the where, I think for me, what I invest in is probably the key part here. Is that if anyone's listening to this and thinking, well, what do I invest in? I.e., what asset type?
Why is probably more important, right? So I've got that backwards. It's not where, what, and why. It's why invest.
What
do I invest in,
and where is that?
And where is it?
Yeah. And why to invest for me in property in particular? For me, it's the same reason why we invest in anything that should have a minimum 10-year hold. Because for me, I'm not buying property. If I'm buying myself an asset right now, I'm not buying it for an outcome next year or the year after or even in 3 years. I'm buying it for an outcome in 10 years and 15 years. And that outcome is either growth, it's development upside, or it's cash flow. Typically, it's one of those three things. Sometimes can be a combination of two or three of those things. So for me, that's what you've got to get realistic on. And that should be dictated by your terms. You know, how much income do you have now? How long do you expect to be in the workforce for? How much can you actually put in as far as your own time, your own effort if you're going to develop the property? How much growth do you need to get out of it? Is it a problem, or is it going to be something that you plan to sell or hold or pay down, etc.? There's a whole bunch of that we have to consider when we're talking to clients for the first time. And then it's the what do I invest in? That is a reflection of why am I investing? And essentially, once we go through those aspects, then you should be able to answer that question pretty clearly. But if I'm investing, and let's say, for instance, the person listening to this is thinking, well, what do I invest in? I know why I want to buy it. What do I invest in? The majority of the things that I'm trying to get outcomes on, and the really predictable things, going back to this data that we're talking about, a few basics. Freestanding established houses will perennially outperform any other residential asset classes. Now, if you stick to those two, more often than not, you're going to see a superior outcome to other asset classes. Now, I'm not obviously suggesting that it's always going to win hands down, but those two things in particular mean that you're not paying for any overheads that are unnecessary buying brand new, and you're typically buying an asset, part of the asset value that increases in value, i.e. the land. You're buying land, and typically the more established a property is, the more valuable the land is, the more that land goes up in value versus brand new. Then it comes down to the other aspect, which I think you have to consider, is the cash flow. So what do I invest in? Do I invest in an asset which I'm happy to park a bit of low money, i.e. 2% yielding money, and that might be Sydney or Melbourne or even Canberra or realistically parts of Hobart right now. You're seeing markets there 2, 3, 4%. Is that going to be great if you're paying 5% interest rates in 3-4 years? Well, if you're happy to take a negative position on it and you're going to speculate for a 10, 15, 20-year hold, it's fine. But if you can afford that, fine. If you can't afford that, then you need to consider, well, where else can I get a 5% return? Where else can I get an area that's got a sub 1% vacancy rate? Where else can I get an area that's got a 10% annual rental growth position? So that actual rent's going to continue to increase. And those markets exist. And then it comes down to the where. Well, for me, those markets, if I'm putting money into the areas now, I'd probably be suggesting, again, freestanding, established houses, areas that are going to see minimal supply. Perth, south of Perth, Adelaide, pockets of different areas up and down the coast from Adelaide itself right now. Brisbane, southeast Queensland, still looking very attractive. They're probably the three markets which, depending on where your budget sits, I'd still personally like to see people targeting between that, probably as low as 300K, as high as 700K. They're the markets which will still fit those other narratives that I talked about. Is higher cash flow, minimal supply, low vacancy rates of sub 1%, and economies that are tracking sub 4% as far as unemployment rates are concerned. The rest of it, for me, we'll have this discussion in 2 years. That discussion will be different. Those where options, look, I don't doubt that Sydney will see some great opportunities in 2 years. I don't doubt that Melbourne will see those same opportunities. For me, it's probably just not right now.
And what do you do? How are you going to know when it's a good time to strike in those capital city markets like Sydney and Melbourne, which are the headline markets, right?
Yeah.
When do you know? Because it's hard to pick the bottom.
Yeah, absolutely. Well, really good example is between 2000 and let's say 2012 and 2017, we saw Sydney as an example grew by about 70 to 90% in that 5 to 6 years, depending on where or what you're looking at. It went from interest. We can speak to some properties. You got your portfolio. I've got properties in my portfolio. A property in Campbelltown as an example. So southwest and Sydney suburb at the time I bought it. Interest rates at the time were about 6.5%. I bought a property out there, freestanding corner block house, had an interest rate at, like I said, 6.5%. The yield at the time was 7%. Now 7% right now for those markets unheard of. However, if I compared it to, and even if the interest rates were 3%, it'd still be ridiculously high. So it wasn't. It was a relative number against the actual interest rate I was paying on my cash. But that market grew, rents didn't grow, and it essentially became about a 2 or 3% yield by about 2017. If we go back to the Banking Royal Commission, that market came off. So Sydney in general, and everyone has to remember this, that we did see the Sydney market drop by about 15% in 2 years. Some areas of Sydney, the more affluent markets, dropped by over 20% in that time. As that came back, rates came down as well, and we actually saw the difference between the rent and the actual holding costs of those properties was almost neutral. So we bought again in places like Campbelltown. We bought again in places like Liverpool. We bought again in places like Parramatta, in Rouse Hill, out towards Blacktown, further towards Penrith. We bought in those areas between 2018 and 2019. We probably bought about 100 properties in that time for people who were looking to get some exposure, more around that 500 to 600K price point. Now, the yields were about 4% at that time, but interest rates were about 3.5% to 4% for the average retail rates. So it was actually cash flow neutral. Now that's grown again. We just went through this cycle. They're probably more like, once you factor in the 20, 30% growth they got over the last 2 years, they're actually now yielding again 2 or 3%. So they're actually highly negative. So you've got to keep observing where these opportunities are, where they're not. And those times will come. Don't think about just the random yield number of 5%, 8%, 15%. It's irrelevant. It's the difference between what you're paying and what that property is paying you. That's the machination that you really have to always observe and don't get too caught up in those headline numbers.
But it's really interesting you say that everyone's talking about this rampant increase in rents as a result of inflation, right? Which is happening a lot of places around Australia. But, you talk about western suburbs of Sydney. I'm not seeing it out there yet.
Not yet, no. Melbourne's inner city, Melbourne apartments, a little bit there.
Yeah.
But you're not going to see that. But you go into these other markets and talk about where and why now. Now, Brisbane, as an example, we've seen rents grow well in excess of 15% in the last 12 months alone. Perth's grown well in excess of 12% in the last 12 months alone. Adelaide, well in excess of 12% in the last 12 months alone. Hobart, again, still growing exponentially. So if they keep on that trajectory, what's going to happen is rents will get more and more expensive. The price of holding that asset, even with interest rate increases, it actually isn't changing. So people can pay a little bit more for property. As an investor, you can, because the reality is that the hold costs aren't really changing.
It's worth doing the numbers. You pretty much guarantee that the lenders will pass on the interest rate increases pretty much straight away. It's a lot harder to increase your rents quickly. You know, you got to wait whether it's a transition of a lease or a tenant. You got to give lots of notice. It's not something you can ratchet up really quickly. So you're going to see your cost to hold increase faster than the revenue you can generate from it. But you need to be proactive about whether or not your rents are competitive and preparing for that point. Whether it's when the release comes for a renewal or advising the tenant around it. You need to remember there's a bit of brinkmanship in that also, because if you look at some of those markets up in Brizzy with sub 1% vacancy rates, if you go, look, I'm going to increase your rent in 3 months' time, I don't know how many people are going to go, we're out of here, because it's pretty hard to find somewhere else, right? So this you got to tread carefully. It's you need quite a lot of tact doing it. You got to remember also if you've got long-term tenants, make another $10 a week out of them.
It's a judgment call.
It's a judgment call. So don't get too absorbed in it, but run the numbers. Run the numbers about potentially increasing costs. And your mortgage costs are probably going to increase faster than your rents, and this is when your yield's just going to come down and you might go more into a negative equity position or negative cash flow position, Run the numbers, and that's what the smart investors are doing, working out, okay, should that happen, am I going to be okay? Am I going to be able to hold the line? To Paul's point, you need to be thinking of at least 10-year horizons with property. Am I going to hold it? What cutbacks do I need to make, if any? Can I wear it? Is it just one of those things that you sit there and, I don't know, I know a lot of people, and they're saying it right now, these inflationary pressures are really hitting. It's very visible towards lower income earners, but sort of middle and upper income earners, they're sort of going, well, really? It's $11 for lettuce. Okay. But it'll catch up with them also if they're over leveraged.
Yeah, absolutely.
If they're over leveraged, and that's when the science of increasing rates, interest rates goes up, because at a point in time, it will impact most people, and that will curb their spending. Agree. And that's when you get to the top of the cycle, and then it starts softening again. So anyway,
can I share one market segment which I do think will suffer in the next 2 years, Phil, and put that out there as a headline if you need to. But I personally, what I did see was doing my utmost as a buyer's agent and property strategist, was trying to talk, especially in the peak of our lockdowns, in the height of COVID-19. A lot of people, particularly in the eastern seaboard markets, who were wanting a lifestyle property and thinking, well, I'm not going to go overseas, so I'm just going to buy this property near the beach or on the beach. I'm going to spend heaps of money on it because I can't go anywhere else anyway. Yeah. That market segment, and I'm not talking about a particular area, I'm talking about that market segment. Personally, I've seen it before in the GFC. I've seen it before back in the dot-com crash, and I've seen it before back in the 90s. It's that second and third house, which people don't classify as an investment, but they paid way overs. Yeah. Way overs. For a 2-year period of time, you pick up the phone to any prime lifestyle area and you talk to a principal of a real estate agency, say, tell me about COVID, and they will tell you stories of hysteria like they've never seen. They're the markets, now that international borders are back open. NAB just released some data saying the overseas spending on their credit cards is the highest level it's been in well over 3 years. It's 600% on last year, which is pretty obvious. Yeah. But once the interest rates increase, once the vacancy rates increase, once the bookings decrease, and once people's balance sheets, talking to you about those middle and higher income earners who could afford these things, they're the ones who are going to look at them saying, this might have to go. Yeah,
and I think a lot of it, I'd probably add to that, Paul, and I tend to agree with you, is the practicality of holding these assets, right? Like, and you look at areas closer to the capital cities, and Sydney. Let's look at Wollongong and the Central Coast. Like those markets are bucking the trend because they're actually not lifestyle locations; they're commutable locations. It is. Inverted commas,
like the Geelongs, and a bit further. Like they're still part of Melbourne.
They're still part of Melbourne.
Sunshine Coast in Brisbane. It's still a big bus. We're not talking about necessarily those areas per se.
But we're talking about.
I'll give you some. I'll throw out some.
Okay, throw some.
Byron Bay, classic around that area. Look, the data doesn't show it yet. Give it time. Give it time. You go further up towards the far north Queensland. Give it time. You go up far north of WA. Give it time.
Yeah, that whole Byron Bay hinterland, or even like Lennox or Coffs or Nambucca Heads, like really nice places. Great to go holiday.
I love them.
It's hard though. You've got to get on an aeroplane. Or you've got to actually drive your car for 6 or 7 hours. They're not weekenders. No. Right? They're not weekend destinations.
Not for people unlike yourself with a private chopper, etc.
Yeah, that's right. If you've got your own airstrip and stuff, it's not an issue. But they're hard. They're hard. It's hard work, right? Yeah. Like and when the realities now of business and things getting back to normal, you saw Elon Musk pretty much going, if you're not in the office, I'm assuming you've resigned. Yeah. Like that's one end of it all. But there is an expectations for executives to be back in the office. Yep. You might be able to sort of maybe do 1 or 2 days somewhere else, but are you going to go to the Byron for 2 days? Yeah. Maybe. I don't know.
Maybe.
Who knows?
It's pretty expensive to do.
It's expensive to do, and the repetition of jumping on that plane on Friday afternoon, getting up there, driving to your place, doing the same again on Sunday, it gets away. Yeah, I tend to agree with you that will be the case. I watch with interest though these regional commuter locations like your Gongs and your Central Coast. Everyone's talking about they're spending a crap load of money. The new government's spending a crap load of money in
rail infrastructure,
and upgrades and stuff. They're going pretty much. I know in New South Wales, have got this sort of 6 cities thing. I think 6 cities. Wollongong, Newcastle, Central Coast, some other areas, right? So they want people out in those areas.
Yeah, but they also need people back in the cities to justify the existence
of these infrastructure.
But
they're saying 25 minutes from Wyong to Sydney, right? Yeah. Like that's a pretty easy commute. How far away is that? Who knows? Yeah. They've got to spend money on the rail anyway beforehand. But anyway, I tend to agree. Be careful where you invest. Paul Glossop, thanks for your time.
Mate, thanks for having me.
Always good. It's Paul Glossop, Pure Property Investment. Can you still get your book?
Of course you can. purepropertyinvestment.com.
Have you still got a warehouse full of them?
Mate, I don't actually. I'm pretty skint on them.
Really?
And, we've got to order some more
boxes.
You
got to pay for it now, do you?
Yeah, well, you have to order them. Technically, we still have to. We have to essentially tell our publisher that we've got demand, and then they'll say, well, how many are we got in the needs? And then they have to go to the printers, and the printers have to get them out. It's a bit of a process. About 2 months. Once you need it.
What's the inflation like on books?
So far, it's
a lot of paper comes out of Finland and also out of Russia.
Yeah, there you go.
So there's hikes.
So
a lot of laminate.
I haven't gone that far down the supply chain.
A lot of wood and
So still at any good bookstore, you're still paying $30. You go to our website, free. Just pay for shipping.
Okay. What's shipping mean? A post?
Yeah, post. Okay. So you're talking $8 to $10, depending on where you live.
Yeah, cool.
Yeah.
All right. There you go. Thanks for your time. Remember to check out smartpropertyinvestment.com.au. That's pretty much it for me. Social media, that's how you get your info. Smart Property HQ. If you want to come over and chat with us, if you're an investor, editor at smartpropertyinvestment.com.au. It'd be great to have you on, have a yarn about what's going on. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment Guide today at purepropertyinvestment.com.